best moment of your life?
I would have to say getting married. I'm not going to say birth of children because I have two. So if I choose one over the other, that's I only have one wife. So
Is the U.S. headed for a recession? Will the S&P 500 go up or down next year? And will the valuation gap between large cap and small cap firms converge, and how? And finally, how will AI affect business journalism? I don't know all the answers to these questions, but my guest today might, or at least might bring us closer. His name is Paul LaMonica. He's a financial journalist with nearly 30 years of experience, including more than 2 decades at CNN. He's writing now for Investors Business Daily and Investor Place, and his blog, Rational Exuberance, can be found at substack.com/at Paul R. LaMonica, or he's at Paul R. LaMonica on Twitter/X. And he's a nice guy. I will add this because unlike many business journalism people, he did not get the memo that you're supposed to be rude and dismissive. In the past, when I've mentioned story ideas to Paul that were not like right up his alley, he had the decency to actually respond to me like a human being. So, Paul, thank you for that. And thank you for being a rare, nice guy in the world of business journalism.
oh no, we're not all that bad. But yes, just one minor correction. It's at LaMonica Buzz on the social media platform formerly known as Twitter.
Oh, got it. Okay, my mistake.
Yep,
At
no
LaMonica
problem.
Buzz. At LaMonica. Okay, we'll
Yes.
put that on the screen somewhere. So quick lightning round just to kind of loosen you up, Paul. No need to think too much. Best moment of your life. I guess it's rather deep.
Wow. I would have to say getting married. I'm not going to say birth of children because I have two. So if I choose one over the
You got
other,
paid. Yeah.
I only have one wife. So
Safe answer.
there we
Well
go.
answered.
Yes.
Last music purchased, at least that you can remember.
I honestly don't remember because I've been using Apple Music, the
Yeah, nobody.
subscription,
It's a
for so
subscription thing these
long
days.
that
Yeah.
I just
What do you typically
download what I
listen to
want.
then? What do you typically listen to?
Rock, jazz, a bit of classical. So that's kind of like the main musical tastes.
And what websites do you typically visit every day, every couple of days?
Still CNN, even though I don't work there anymore. Definitely ESPN. Need to know what's going on in the world of football for my fantasy football team, especially as we're heading into the playoffs. The New York Times, definitely. Wall Street Journal. I'm a business news journalist, so clearly need to stay on top of all of the top breaking news stories.
Makes sense. And so to segue into our kind of main body of questions, you are a business journalist with probably more experience than 99.99% of people in the markets and in watching economics. So if someone is new to the market, Paul, new to watching the economy, how would you advise them right now? Let's say you're just beamed to the situation. You're reading a range of recession forecasts, anywhere from very unlikely to very, very likely, depending on who you ask. Similarly, a range of S&P 500 forecasts for the year ahead, from down, 8, 9, 10%, JP Morgan, to up 20 something percent, some Capital Economics and some of the other. Oppenheimer is pretty close to there. These are all smart people. They've all got some sort of good looking logic. How do you look at all this?
Yeah, it's a great question. I think starting with the economy first, I mean, the recession concerns, they've ebbed, I think, a little bit because we might be all drinking the quote unquote Kool-Aid of a soft landing. It's hard to remember the last time, if ever, the Fed has engineered a soft landing, but I think a lot of people are hopeful that maybe Jerome Powell and company are going to
He's
do it
doing
this
it
time
so far,
around.
right? It looks
But
like
yes, but even if there isn't a soft landing, I think for many people, especially younger people, you hear the word recession. And even though we technically had a blink and you missed it recession in 2020 because of the pandemic, the last real major recession was obviously the Great Recession of 2008, 2009. And when you think of that and hear that, that's very scary to people because that recession was kind of like a depression for a lot of people. But not all recessions are that bad. I mean, the recession that we had in 2001 was somewhat mild, limited a lot to the East Coast and the West Coast, the financial business and the tech business. Recessions are needed and healthy parts of an economic cycle to flush out some of the excess. And you can argue that we've had excess in this market, in this economy, especially with the labor market continuing to be as strong as it is. I mean, that can't go on forever. So I think people need to be wary of worrying about a recession wiping out all of their investments. And you don't want to panic. That leads me into the what do you do as an investor side of the coin. Anyone, especially if they are a younger investor, have to realize that there are going to be up and down cycles. And as long as you don't need that money that you're investing for a period of time in the immediate future, then you have to ride out the cycles, because odds are, more often than not, your money is going to be worth a lot more invested in the market over a period of decades than if you just leave it under your mattress or in a bank account that yields next to nothing.
Yeah, I'm reminded I was just giving a talk the other day to some people, and I just was digging up some stats beforehand, and I found one that the S&P over the past 30 years has averaged about or a little more than 10% per year. But the average mutual fund investor, this is the Dalbar research study, comes out every year, has done about 4% per year. So in other words, if they just sat there and bought the market, they'd have 10% per year, which is fantastic for compounding. But people tend to buy at the highs and then sell at the lows, and so they get less than half the market's return.
Yeah, I think a lot of people definitely panic when they start to see stocks fall and maybe sell prematurely. And conversely, some people are afraid of buying when they think something might be looking frothy or near a top. And yes, that might, for the short term, be a signal that things are going to pull back a bit. But even if you buy at what seems like a top, it's probably not going to be the top, because I don't think that, even with the Dow hovering, around 37,000 now, 20 years from now, I'd be very surprised if the Dow isn't
Yeah,
significantly higher than that
yeah,
number,
37
even
will look
though
ridiculous. Yeah.
37,000 seems almost impossibly high.
Yeah, it's an interesting time. On the flip side, I would say you and I are both we're Generation X, but I've got some younger millennial friends who basically came of age during the last 13, 14 year zero interest rate or almost zero rate bull market. And to them, at least for the longest time until last year, trees grew to the sky. I think they would tend to assume they had much more bargaining power in the workforce, right? Because we had super low unemployment, and now suddenly they're realizing, hey, crap, the party doesn't go on forever. So, but I think that's probably a healthy thing, a good thing. As you said, recessions shake out excess, and we just had a lot of excess.
Yeah, definitely. I mean, wage growth, I think particularly, in the midst of the pandemic, we really started to see companies wondering how they were going to get workers, quality workers, especially in service oriented industries. And I think it's been good that we've had the type of wage growth that we've had over the past few years, to maybe narrow, not eliminate, obviously, but narrow some of the yawning income gaps that we have in this country. And
Yeah.
having certain workers having a little bit more leverage isn't necessarily a bad thing. But you're right, we are seeing, James, that you're starting to get this compression. Wage growth is not as robust as it was just a few months ago and a year ago. But that's potentially good news, because wage growth is what really historically drives inflation. And if wage growth starts to cool, that's what the Fed is looking at, then we might get all of those interest rate cuts in 2024 that the market is now pretty much banking on. So you got to hope in some respects, even though like knee jerk reaction would be like, yay, wages are going up, I'm getting more money in my paycheck. The Fed sees that, then all those rate cuts that we've been planning and anticipating for next year, and there's a potential reason to buy stocks, they're not going to happen if wage growth accelerates again, because that's going to lead to more inflation pressure.
Yeah, good news is bad news, right?
Yeah.
And somewhere I think there are some auto workers smiling at some of your former comments there, Paul. Let me segue to you personally. What is your financial information diet? Like, what indicators you should watch, and how do you invest personally?
Yeah, I invest, mainly, to be honest, in I have a handful of ETFs and funds. I think really looking at a broader, longer term approach. I've historically tried to avoid investing in individual stocks when I was at CNN. Didn't want to have any conflicts of interest. And I always would disclose this. I have two stocks that I owned personally because of a wife's family member who had gifted them to us after she passed away, Abbott Labs and AbbVie. She grew up in Illinois and worked at Abbott for a long period of time, and then they spun off AbbVie. And then the only other one is what is now Warner Brothers Discovery in my old 401k that I still have, obviously, even though I'm no longer at CNN. So those are pretty much the only individual stocks I own. Everything else, it's diversified. It's trying to take advantage of the fact that over time, longer term, you're going to benefit from appreciation in the U.S. and international stock markets. I'm getting older, so starting to think about a little bit more fixed income potential as well. But I'm not that old, so retirement is not staring me in the face at my doorstep. So, not looking to go all into bonds just yet. I don't think anyone in their right mind wants to do that when there's still the potential for nice gains with stocks. But it's mainly stocks and fixed income. I'm avoiding things like crypto that to me are still fun if you have the money to play around with it. It's kind of like going to a casino still in my mind. Like, I will go to Vegas from time to time, and if I lose a little bit at the blackjack table that I know isn't going to hurt me, that's kind of how I feel about crypto. If you've got money that you don't worry about losing, you can put some of it in Bitcoin or other coins, cryptocurrencies that are out there. Although if we do get finally those ETFs, the spot ETFs approved by the SEC, that could potentially change things a lot.
Yeah, bring a lot more money to the market, institutional as well as retail. I'm kind of like you in that point. I mean, I own a little bit of Bitcoin. I bought it just kind of as a test, but it's just a minuscule amount.
Right.
And I'm not convinced of the use case. I'm not convinced of how good it is for society or not. I mean, it's supposed to solve all these problems, but it seems to add just as many, if not more, than it solves, at least so far. But we'll see. It's still early days. Yeah. Back to stocks. So we emailed briefly about this valuation gap we're seeing. I think it's the largest gap in 25 years between small caps and large caps. So another way to express this point is if you look at a chart, the S&P 500 is up about 23% year to date, which is ironic, by the way, because a year ago, everybody said it was going to drop, but 23% because of that optimism for the Fed. Equal weight, it's just barely up a little bit. So you got 7 or 8 big tech stocks that are essentially running away and dominating the index, and the little guys are just kind of mulling around, stuck in the doldrums. Will the valuation gap close, number one? And B, how? Do you think it's going to be more large caps coming down or small caps coming up?
Yeah, it's a great question. And obviously, when you look at the equal weight of the S&P 500, you're still talking about very large companies. The Russell 2000 is clearly underperformed the S&P 500 as well. And I think that's where it gets at the heart of the small cap versus large cap, mega tech part of the story. I find it difficult to see how small cap valuations can improve that dramatically if we are legitimately worried that all of these rate hikes that the Fed has done last year and the earlier part of this year eventually cause the economy to slow down more dramatically than hoped. So I think that's potentially an issue for small caps. I think that, valuations, I think it's going to be difficult for small cap valuations to increase dramatically if the economy does slow next year because of the cumulative effect of all the rate hikes in 2022 and earlier this year before the Fed paused. I mean, we likely will get those rate cuts next year, but there is that lag. So if the economy just slows down a little bit, many of the domestic oriented small cap companies that don't have that same international exposure as the mega caps, I find it hard to imagine that people are going to pay up for potentially slowing earnings growth. That being said, the large caps have to come back to earth at some point, particularly those mega techs. They can't keep growing on AI hype indefinitely, even though that's helpful for NVIDIA and Alphabet and Amazon, for now. So I would say that there's going to be maybe not that much of a narrowing of the gap, because I think if anything, valuations will, decline a little bit for both large cap and small cap.
Got it. Got it. So, I mean, some people are saying, small caps are down because they're more exposed to, they have more debt. First of all, they're,
Mm-hmm.
less cash, generally weaker financials, and so when more variable rate debt, especially, so when rates went up, they're paying more on that on interest, I should say.
Mm-hmm.
But so that'll improve if rates go down. But it sounds like if we have a slowing economy, that's going to more than compensate for that. As you said, small caps are very domestically focused in their
Mm-hmm.
business models.
Yeah, I think that is primarily the concern, that if the domestic economy starts to decelerate, then that will potentially hurt the revenue and profits for these small cap companies and large cap companies. Many of them obviously have debt as well, but their balance sheets. That's one reason why I don't worry about another 2008 style type crisis,
Mm-hmm.
is that many of the biggest companies, even the banks, are part of that. They're not nearly as leveraged as they used to be. So I think that is potentially a good sign, and it'd be one reason why I wouldn't feel the need to go rushing out of large cap stocks just yet. I think you just maybe want a little bit more diversification,
Yeah,
to the rest of
makes
the
sense.
S&P 493 as opposed to just the Magnificent Seven.
So you mentioned AI. It's been the hot theme this year. Another one has been this GLP-1 agonists. Uh, they're supposedly changing the world, but nobody knows exactly how. Do you think that trend is overblown, or are we just in the early innings?
Uh, I think we probably are in the early innings, because it sounds as if, from my reading up on the subject, the companies like Novo Nordisk and Eli Lilly that have been probably the biggest beneficiaries of these drugs, Ozempic and Manjaro, and the new indications, the new names that come along with them. Right now, it's primarily diabetes and obesity that these drugs are being used to treat. If you all of a sudden get these types of medications opened up for other indications like cardiovascular disease and other diseases that are adjacent, that could help people lose weight, live healthier lifestyles, then you have the potential for even more revenue. I think that's the reason why
Yeah,
Novo Nordisk, you're seeing such great results for that company as of late. What I do think though is overblown is not the potential for these drugs, but this mere notion that we're all going to stop eating everything unhealthy, and that the Cokes and Pepsis and Hershey's of the world, Mondelez, that these big consumer staple food and beverage stocks, some of them have been hit pretty hard, but there's really no evidence just yet, even though some retailers have talked about the possibility that there could be a slowdown in consumption. I don't really buy that we're going to stop uh, buying unhealthy food entirely. Uh, and many of these food companies are, to their credit, doing a good job of trying to find better types of products that aren't as laden with sugar and other unhealthy ingredients. So I think that writing off the big food and beverage stocks because of Ozempic is probably overdone.
eating junk is pretty much embedded in the DNA of our nation. I agree with you, Paul. If you think we're going to stop eating junk, dream on. I think it's just how we are. But
Yeah.
they're interesting. I mean, they reduce addictive behaviors, from my understanding.
Yes.
So alcohol consumption goes down. It could affect video game, and drugs and things like that too. So we don't know the long term effects, but it's
Right.
certainly
There
a
are a
very
lot of potential
interesting.
ripple effects here. Yeah.
Yeah, very interesting thing. Shifting gears entirely now, because you have such a wealth of experience, nearly 30 years in business journalism. I just wanted to ask two questions. So, AI has been a hot investment theme this year so far, certainly great for NVIDIA holders. How do you think it's going to affect over the next 5 years journalism, business journalism, or journalism at large?
Yeah. I mean, we're already seeing the impact on business journalism and the broader world of journalism as more mainstream news organizations use artificial intelligence for writing stories. I think that this is going to not necessarily upend journalism, but just accelerate some of the trends that were already in place, namely that for many news organizations, the facts-based business of getting information out in a timely fashion, correctly and before your competitors, that's increasingly become commoditized over the past couple of years. And I think where the value really lies is with news, if you want to call it news, or commentary, if you want to say that that's really what it has morphed into, content that has a bit of a voice, some flair to the writing, a bit of an edge, a take. And that doesn't always have to mean to the left or to the right from a political standpoint. It could just mean writing with color and edge and attitude. That is something that I hope and pray AI never fully supplants. I think that there will always be room for great writers on various news websites and TV video platforms to share their thoughts and analysis that people will value over something that ChatGPT may spit out that for the time being might be 100% right or could be factually laden with errors.
Yeah, yeah, I've noticed that too. You know, AI just grabs what's out there, and a lot of what's out there is true, but a lot of it isn't. And
Right.
sometimes it'll have, and usually not egregious mistakes, but sometimes and sometimes just little misunderstandings or
Mhm.
things that don't betray an expert knowledge on something. So I'm just been personally, I don't use it. I'm going to dedicate a day or half a day to just reading about how to use AI and writing
Mhm.
just for fun. But it just to me, it's just not quite there yet. Although I'm not saying it won't be one day.
No, I agree. I think that we are going to rapidly reach a point where AI will become far more sophisticated, have fewer mistakes, and become something that particularly people of a younger generation who don't know anything different will come to accept. But we're not there yet.
So, final question, and we spoke a little bit about this right before we recorded. Washington Post is struggling. CNN has struggled. The New York Times is doing okay. Across the media landscape, though, generally speaking, it's been a horrible time for the past decade. The number of newspapers in the U.S., live TV viewership, it's all down. Social media has ballooned and siphoned up so many eyeballs, so many ad dollars. But in a way, social media kind of needs media because if I'm just some opiner, whether I'm on the right or the left, I need to have some basic information first, right? Somebody's breaking the story. Somebody's got a man on the ground or a woman on the ground breaking original news, and I'm relying on some of that usually, depending on what I'm doing, right? My question is, with all the ad money going away from traditional media, from the original news, and into social media, into the opiners who don't pay anything to get those that information, um, what's the solution? Like I offer they'd have a BBC solution where the government funds more media, but that can be contentious. I think you're saying. What do you think happens here?
Yeah, I struggle to imagine in this incredibly polarized world we live in politically how a BBC type model in the US could work without there being accusations of partisanship on both sides, and especially with the massive shifts that we've seen politically, it seems that the moderates in this country are increasingly quieter, or their voices have been drowned out by the noise. So I think I struggle to imagine how people would take seriously a government funded news organization that had the BBC as its model without there being constant accusations on both sides of there being bias. That being said, you're right, James, definitely that the traditional news media business has struggled. The ad solution, the advertising based model is clearly one that is challenged right now, especially with social media. I think a lot of people feel that, why spend as much on a mainstream news organization when I can go all in either on search, be it Google, be it Apple News and their news aggregation giant, or with social media sites, particularly ones that cater to younger viewers. I mean, I think we have obviously seen that traditional linear broadcast TV and cable TV aren't as alluring to a younger generation as TikTok, and YouTube and other social media platforms are. So that's why I think a lot of the dollars are going to be going there. For a mainstream news organization, I think that they probably are going to increasingly look to premium type products. Subscriptions for those who are willing to pay it are a way to monetize content, even if your overall user base is not as high as it would be with a free ad supported product.
Yeah, yeah, I think it's the cleanest solution. It filters down to their tribe, the people who are willing to pay,
Yeah.
rather than. I mean, I know somebody at NPR, and NPR gets, I think it's less than half of 1% from the government of revenue, and they still get heat all the time, criticized
Mhm.
left and right for that, and that's just like a microscopic
Right.
percentage of their funding. So imagine if it were 80% or 90%, it would be probably
A
exponentially
nightmare.
nightmare. Yeah, yeah, I think you're right. It could never fly. So hopefully, though, I mean, someone who uses and enjoys quite a bit of original media, and I subscribe to a number of platforms because I want to support that journalism. It's important to me.
Mhm.
Hopefully, we can find a solution.
Yeah, I hope so too.
All right, Paul,
Don't
you've
want this
been very
business to
generous with
die
your.
out.
Yeah, yeah, definitely. You've been generous with your time. I certainly appreciate it. I believe those watching at home have as well. I will put your blog on in the notes and your Twitter as well. Again, thank you very much, and thanks to you guys as always for watching us at home.